Hi everyone, welcome back to Stephan Livera podcast, brought to you by Bold. For American listeners, go and buy Bitcoin over at getbold.io. Now, rejoining me on the show today is James Check, aka Checkmate, and listeners might know James from his Substack, Check on Chain, and some really great analytics. I'm actually a subscriber myself, so I enjoy checking out some of the work there. Welcome back to the show, James.
G'day, mate. It's good to see you again.
Yeah, so look, there's been a lot of different things happening. Obviously, we're kind of going through a bit of a down bit in Bitcoin right now. And I saw some really interesting comments you had, and I think it's reflecting a sentiment we're starting to see now, which is this idea of there is no cycle. I'm curious, can you elaborate a bit on this idea? What does it mean if there is no cycle?
Yeah, I think the best way to think about this, first things first, the market's going to change. Things are going to evolve. Bitcoin's going to evolve. Clearly, we're in a very different analog now. So I've been observing just the way that Bitcoin trades, and a couple of things started to I guess, kind of prick my ears. And as I'm looking at all these different metrics, there was three very distinct regimes I started to notice. If you go up to the 2017 peak, I would describe that as very organic, very grassroots, very human being. People were just using their instinct. Oh, it feels like it's run too far, or this feels like a good time to buy. And there was like a very, people weren't using charts. They weren't doing complex T8. They were going off pure gut feel, and Bitcoin was being adopted. What is this weird internet money thing? I guess I should buy some. So that up to 2017 was very much just a pure grassroots adoption phase. The 2018 to the 2022, basically till FTX blew up, that period was high amplitude, high octane, straight up, straight down, lots of bull markets, lots of bear markets, lots of leverage, just a different animal. And it was very high amplitude. And if people want to actually go and visualize what I'm talking about here, look at the Mayer multiple, just a ratio between price and the 200-day. That 2018 to 22 period was just straight up, straight down, straight up, straight down. And people got blown up there, right? I called it Schrodinger's Bitcoin because it was both alive and dead. You know, the critics are telling us we're not going to make it. The believers are like, no, this thing's going to, it's going to get there. And we kind of memed our way to where we are today, which is much more stable, much slower. A 20% correction is a big correction these days. And we're doing it from a $2 trillion asset. Yeah, again, if you go back to the Mayer multiple, the amplitude is much smaller, but it also oscillates differently. It doesn't have it's the same spot-driven dynamics as 2016, 17, but at the same time, it's different. It doesn't have the same swings to the upside and the downside. It's a lot more controlled. So when I start talking about there is no cycle, at the end of the day, I'm a huge proponent of markets are just information. It's just information. The only thing we as people, investors, hodlers, analysts, the only thing we can control is our decisions. So what I'm trying to get across with that message is actually to stop thinking so much in it must do this because it did this in the past. Let those kind of anchors go and just allow the market to evolve around you. Things are going to be different, and that's okay. What it means is that using past cycle top indicators, for example, you might have to actually take a step back and go, well, why was that a top? Did that actually make sense? Does it make sense for that to be a topping signal in this current cycle? And almost bringing it back to first principles. What am I looking for to establish these dynamics? So it's almost just letting go of those past biases. And to really, if I was to summarize it all in one thing, the 2017 run was the world reacting to Bitcoin for the first time. What is this thing? That middle period was a transitional phase where we learned about what Bitcoin is. And here we are in 2023 onwards. We know what Bitcoin is, and rather than us responding to it, it's responding to the world. It's a reflection of macro dynamics and liquidity and market sentiment and tariffs and all this other stuff. So in a way, Bitcoin's kind of evolved to being that macro index, which is a fascinating concept to itself.
Yeah, interesting. So yeah, a few things I want to react to there. So I think it was historically kind of true, and especially for me coming in 2013, it was a wild, wild time. The moves were so much bigger than they are nowadays, percent-wise at least. Dollar-wise, obviously, much bigger now.
That's a topic to itself too, by the way.
I think historically, people kind of got attached to this idea of, 3 green, 1 red, right? This idea that we're going to have 3 up years and 1 down year. And so most people have just kind of been, in the back of our minds, we've been sort of looking at it thinking, oh, okay, this must be the up year and next year is a down year.
All-time high, December 18th, 2025.
Right?
Guaranteed.
Yeah, so that's kind of like, that's what many of us are kind of patterning. We're kind of pattern recognizing and going, oh, that's what happened before, so maybe that's what's going to happen. But actually, it might not. But let me give one small counter argument that, a lot of people say this time is different, right? Or even in the 21-22 cycle, there was, Zhu saying up only, or there were people
Super
like
cycle.
I don't know, like a Dan Held or others who were saying super cycle, and this idea that maybe we would only have small drawdowns and we're gonna just keep pumping, but then actually we did have a big drawdown. So how do you make heads and tails of that? Like, is it just people who are saying this time is different?
Totally. No, the four most dangerous words in finance. And this is the thing, right? I come in every day when I go to analyze the market and go, I know things will be different. Every cycle is different. The world changes, so things are different. But also, you have to hold both competing views at the same time. What if it's not different? So then I try to again, we have to use pattern recognition because that's really all you have. You can't tell the future. You have to look at what past things have done. And that's why I draw a lot of parallels here. We're very similar to the 2016-17 cycle, both in terms of performance since the bottom. And that alone is amazing. The fact that as a multi-trillion-dollar asset, Bitcoin still moves like it did back when it was a couple of $100 billion, less than, is incredible. So that's the first thing. I also think it's very spot-driven. The ETFs have no doubt brought in a true spot bid. And if you go back to 2017, we didn't have futures. We barely had stable coins. It's basically Bitcoin and shitcoins around it. That was it. So you could only buy a spot. So we have that in similar. We do have derivatives now, but they're being used in a very different way. If you go back to 2021, it was buy Bitcoin, put Bitcoin on exchange, lever up that Bitcoin, go long Bitcoin. And then when the price goes down, not only does your futures position get wiped out, but your collateral falls in value too. Now, if you look at the derivatives market, options are now as big as futures. Options were nothing back in 2021. They're now as big. Options are a more sophisticated instrument. You're not going to have that many retail guys in there trading them at this point in time. There'll be some, but for the most part, it's more sophisticated actors. The leverage is, all the margin is either stable coins, fiat, or very little of it is coin now, which is good. And a lot of it's in the CME. The CME is now bigger than Binance. And again, these guys are professionals. So it's professionalized, probably the right way to frame it. So we've got little bits and pieces from all these different market cycles. And in many ways, let's go back to that super cycle idea. What is, and I say this all the time, what top? Which top? Because there's been so many tops. The top is the one that matters for you. A lot of people think about these cyclical tops, which of course happen. But if you think about the kind of tops we've had so far, they've been miniature blow-offs. We had all the excitement from the ETFs, and then we just exhausted demand, and we chopped around for 7 months. And then we had Trump coming into power. We had this, enormous boost, and then we've pulled back. But if you look at that in context, remove those narratives, it looks just like a rally and a correction in 2017. Ironically enough, it looks just the same. So, the idea of a super cycle, the world does move cyclically, but if Bitcoin's no longer moving its own 4-year kind of pattern, then it's probably going to move more like the world, which is typically like an 8-year or a 12-year. And even that's changed because when was the last major recession, right? 2008. That's kind of how far back you've got to go. I mean, there's areas where you could argue, but it's kind of semantics. And this guy defines it recession, this guy doesn't. The world is also in a somewhat different place. Fiscal dominance, that is a shift. So I think that's probably the way to think about things. Don't look at things in terms of past must repeat. It'll rhyme, but it's going to have tunes from all different parts of the market, depending on where we are at.
Yeah, I think that's a great way to put it. I agree with that. And let me summarize it this way. It's almost like you have to understand structural shifts in the market.
Absolutely.
As you said. So as you said, we've now got this whole new thing, ETFs, right? Whether we like them or not, of course, we as, let's say, if we're ideologically kind of Bitcoiners, we want as many people to hold our own keys and, get your cold card and all that sort of thing. But we know there's also a lot of these new people who are coming in through ETFs and through the micro strategies of the world, or strategy now, the Bitcoin treasury companies of the world, the Metaplanets, the Semler Scientifics of the world. That there's a lot of people who are TradFi boomers on their boomer brokerage terminal, and they look it up and they buy whatever, iBit or Fidelity or Bitwise or
their
whatever.
investment manager just sticks 1%, 0.5%, just like sticks that in their portfolio because that's the model, right? These are also dynamics. They don't even really care. They don't know that they own it. They're happy that they've got something in the portfolio and it's being managed by someone else.
Yeah, exactly right. And so then I've heard people make the parallel with when the gold ETF came out and kind of look at what happened the decade after that and so on. So, and to me, this comes back to the classic Bitcoiner saying, which is zoom out, right? Because what would happen, and sometimes many of us, if we're kind of getting asked by, let's say, news or radio to kind of come on, as an example, here in Dubai, every now and again, the Dubai Eye radio channel, whenever there's a big move in Bitcoin price, they ping me and be like, hey, Stephan, come on the show and explain to us what's going on. And then I'm often there basically rewording the two words zoom out, right? Because I'm sort of saying, look, you can't expect that, Trump announces Bitcoin reserve and we go to the moon tomorrow. Well, no, that's just not how it works. It's more like something structural has shifted. You've got to zoom out and you've got to understand that we're now in this kind of broader uptrend.
Totally. And that's the thing, like if we really take a step back and look at the current market structure, it's up, sideways, up, sideways, up, sideways, right? Now, some people will argue it's not really sideways, it's down. It's like, okay, curve your box a little bit. Now everything's inside, right? So it's like, let's not get caught up in, semantics of whether it's sideways or down. At the end of the day, what is a correction? If you really zoom out and you look at it on a monthly chart, it's literally a bunch of candles next to each other. Yes, it sells off on the daily time frame. And this is another thing where a lot of people get stuck. Our emotions live on the daily chart because we live our lives day to day. So a lot of people will check the daily price, they'll see the daily sell-off, they'll see the next red candle, and that's where their emotional state is. But if you go and look at the monthly price chart, you're like, oh, it's going sideways. It's fine. It's basically the exact same price that it was 3 months ago, 4 months ago. So you just kind of think about it from that lens. Bear markets are when we start making lows and it just keeps going lower and keeps getting worse. So, it's one of these dynamics. You're right. You've got to refactor the word of zoom out. Just helps people take a step back. And to kind of close out that previous point, I think a lot of these tools that we use, whether it's on-chain, whether it's derivatives, whatever it is, coming at things from a first principles perspective, I think is going to help a lot of people. Just because this metric hit this level in the past doesn't mean it has to hit that level again. Doesn't mean it won't hit that level again. We have to think about what got it there. What was the dynamics, right? In 2019, we had the plus token Ponzi. In 2021, we had GBTC hoovering up 600,000 Bitcoin. There's they've got FTX and fraud and all sorts of stuff. Every market cycle, if you actually didn't have a halving, you could just as easily explain it from all sorts of other factors, and all of them play a role. And I think that's probably the way to think about it. What are the factors that are having a role? In our current environment, it was obviously the ETFs in the first part of last year, and I would say most of last year. And then this year, we've seen, if you look at who's buying those ETFs, the 13F filings, they're serious institutions. There's a lot of hedge funds, there's a lot of fast money and arbitrage companies, but a lot of them are actually just buying like 0.01%, and that's millions of dollars, right? 0.01% of their portfolio. They're not going to care where that goes. It's a tiny portion. What happens if they get comfortable winding up to 0.2%, 0.1%, 0.5%? Suddenly you're talking about serious money.
Yeah, exactly. And so I think one way to understand some of what you're saying there is really understanding what are the big drivers, and then maybe understanding, has that kind of dialed up or dialed down? So I'll give an example. In the early years of Bitcoin, the halvings mattered so much, right? That was
Totally.
a big driver. Nowadays, it's probably fair to argue we should dial that down in terms of how much weighting are we giving? Okay, halving is maybe not as important now. What's more important is some of these other factors, right? ETFs, the kind of the Bitcoin treasury companies, just kind of more, let's say, the Fidelities of the world and the BlackRocks of the world telling people, here, you have my blessing. It's okay to buy some Bitcoin in your insurance or in your pension portfolio, this kind of thing. Those factors matter a lot more now than, let's say, the halving.
Absolutely. And I think as Bitcoin gets bigger, I think it's easy to get lost in the trees. You forget how big it is. So Bitcoin, the way I've been describing it, it's the biggest fish in its pond. And it just has no equal, right? I've been using some of these stats recently. If you took the remaining Bitcoin to be mined and gave it a market cap, it's the 5th biggest coin. It's after Tether, right? So it just shows how small everything else is. The intraday moves of Bitcoin's market cap is bigger than Solana. It's like 40% of Ethereum. These things are just irrelevant by comparison. So Bitcoin is now so large for its pool, but it's only just swum out into the biggest ocean, which is just macro markets. So in a way, it's just kind of left the world that it's come from behind, and it's now in a world that's just so much larger. So a 50% move, and you mentioned dollars and percents. This is another thing that's getting quite interesting. I'm still trying to get my head around it. Something I've noticed this cycle, and maybe you have too. On Twitter, a lot of people, particularly when the market's down, they're saying, oh, it's down $30,000 or it's down another $20,000. I don't recall people talking about it being down in dollars as like a dominant narrative. Usually it's down 15%, 20%, 30%. And I've been trying to work out why this is. To go from 100K to 150, that's a 50% move. Most people who've been around in Bitcoin, you've seen a handful of 50% moves, probably in both directions. It kind of feels somewhat normal and expected. That's $1 trillion market cap. That's $1 trillion to the market cap now. It's an absolutely massive number. So in terms of the dollar move, it's going to take a lot of energy to get there, right? My estimate probably needs the ETFs to, I don't know, add another 50% to their size. They've had 40 billion. It probably needs another to 60 or something 70 billion before we can get up to that 150K mark. I think it'll happen, but it's going to take some time. So there's that kind of dynamic. But then I also think about people looking at their portfolio. And if you've been in Bitcoin for a little while, the market pulling back 10% could be a year's salary of yours back in the day, right? So now the dollars sign for the individual who's been around for a while is so much larger. They're actually not worried about percentages anymore because they're looking at the actual number moving around, their net worth. And that is now more significant to them than the percentages, which I find a really interesting dynamic. I'm still working on that idea, but it's a new trend that I've seen. People talk about dollars down, not percent down as much.
Yeah, that could also be a function of just newer people, right? Like if
Could be.
someone's a bit more of a noob, they're not comfortable with a 20 or 30% drawdown because they're coming from like the world where they're holding S&P and 5% down is a huge day for the S&P, but
Totally.
for Bitcoin, it's like, it's a Tuesday, you know, it's whatever.
Totally.
So
But that's the
there's
thing,
that
like
aspect,
I do
yeah.
wonder how many people buy Bitcoin and are surprised that it's volatile. And it's historically, this is the lowest volatility we've ever seen in a bull market, like not even close. We're a third of what we had in 2017. It amazes me that people, and I see this commentary all the time from TradFi bros, they're like, all the ETF guys, they're just flaky, you know, they're flaky hodlers and they'll sell the moment that it gets volatile. It's like, dude, no one's buying a Bitcoin ETF. They've been hammered for years in the media that it's dangerous, volatile, and speculative. Now they've gone and bought some and it's volatile. I would be shocked if they're like, oh, what? No one told me that. It's like, come on, everybody knows that. And I just feel like the media's done the exact right thing, conditioned people to say it's volatile. So when they come in and it goes down 20%, they're like, hey, that's actually not as bad as I thought it was. And suddenly they've actually been conditioned without even holding it to be ready for what's actually coming. And now it is trading down 20%.
Yeah.
People are terrified.
I mean, I partially agree, but let me put. There are some, let's say, anecdotal but probably useful examples. Like there are people I talk to, and some of them are, let's say, managing high net worth clients, and some of them, because they're noobs, they bought maybe close to 100. Or maybe a little over 100. And so maybe once it kind of, because it went up to like 108, 109,000, something like that. Yeah. And then when it got to kind of about 100, maybe they're okay. But once it got down to kind of into the 90s, into the 80s, some of these guys were really scared because, you know, their entry point was well above that. And for them, if you're a noob, and here's the thing. Risk tolerance, it's one thing to say, right? It's easier to say, hey, yeah, I'm gung-ho, I'll hold. But for some of the people who are actively trading, now I'm going to distinguish here. If there are people who just kind of, they don't even know they have Bitcoin exposure, okay, yeah, obviously, they won't even know. But people who actively chose, you know, Bitcoin strategic reserve or whatever, some news, I'm going to buy some. And then now, because they're new, they haven't actually gone through these 80% drawdowns. So they're not used to that. So it's a big deal for them. So maybe some of those people, they're the ones selling. And I think that comes to, you know, what you're doing when you look on chain and you're like, okay, what are the short-term holders doing? What are the long-term holders doing? And that's where you can sort of, you know, look at some metrics and understand which cohorts are selling at this point.
And that's the thing, right? This is what I love about on-chain data. First of all, it's all of us. And what do human beings have? We have 100,000-year-old hardware in our brains, emotional hardware that is ill-equipped, totally, perfectly ill-equipped to deal with markets. The way that our brain is designed, I don't know why it is, just is the case. the natural behavior that we want to do is generally the exact wrong thing to do. People always buy when it feels the best. And when does it feel the best? When everyone and your mate is cheering, going, yes, this thing's got no ceiling, let's go. And then if you look at the behavior patterns of what the smart money, people who have mastered the skills of going, this is what my ape brain wants to do, but what should I actually do? Probably the exact opposite. So at the time when it feels the best, usually funding rates are really high because there's too many degenerate trading gamblers. Many of our metrics showing profit taking are at all-time highs. Long-term hold, the sell side is maximum. If you look at all these conditions, it doesn't mean it's going to be the top, but the probability that you're buying high is much higher. So the guy you were just describing who kind of bought his first Bitcoin at 110,000, it felt great at the time. Probably feels pretty shit now. And it's just about, that's what I use on-chain data for. It's just to look at what everyone else is doing. What's the smart money doing? What's the fast money doing? When the fast money buys high and then sells low, now I'm interested. Now we're talking about an environment where the dude who is panic selling, he's probably going to panic sell the bottom. Why? Because that's exactly what I did back in 2018. I panic sold every bottom and I panic bought in FOMO on every rally. And I was wrong, perfectly wrong every time. If you can take your emotion out of it by just looking at what everyone else is doing, be like, oh, I'm going to do the opposite of that guy. I'm going to do exactly the same as this guy.
Back to the show in a moment. This show brought to you by CoinKite.com, the creators of the best Bitcoin hardware security devices, such as the Cold Card Mark IV and the new Cold Card Q. Now, we use Bitcoin hardware security devices to keep our keys offline, our private keys offline. Now, the way these work is you can do that setup, write down your 12 or 24 words on the seed word cards, and keep that secure. Now, you can use this device to interact with the Bitcoin network using software such as Sparrow Wallet, Electrum, or Vector Desktop, or Nunchuck as a few examples. Now, you have a range of security features that you can use with these devices, such as passphrases, you can use seed XOR, or my favorite is multi-signature. Now, if you're starting in a basic way, just start with the device and the USB-C cable, plug it directly to the computer and use it that way, and then later improve your setup. But I believe these devices are great at helping secure your coins, especially as you start to migrate up into multi-signature security. But don't be disheartened or don't be scared away. They are accessible, and I think you actually do learn about Bitcoin in the process. So to get yours, go to coinkite.com, use code Livera to get a discount on your cold card. This episode brought to you by Galoy. They are building banking software for the Bitcoin age. So if you are with a bank, a fintech, or a startup looking to offer some kind of Bitcoin product, whether that is a Bitcoin collateralized loan, deposit accounts, or payments, Galoy can help you. Their latest product is called Lana. It is a loans management platform, and you can use this to come to market quickly and offer a loans or Bitcoin collateralized lending product for your customers. Now, Galoy have a lot of experience in the space. They started with Blink Wallet in 2020, and they've since grown this to become a community favorite over time. And so they have a lot of experience making things work in a secure, reliable, and scalable way. So if you need assistance coming to market quickly with a Bitcoin banking product, such as lending or deposits or payments, talk to the team at Galoy. You can email them. The email is biz@galoy.io, or go to the website galoy.io. And now, back to the show. Yeah, I think it's so right there, the point about dealing with our emotions and the psychology of it. And that's why I think that's probably, I'm not a trader myself, but I think if you want to be a good trader, you really have to separate from the emotion and the psychology and not getting caught up with like the herd, because the herd comes and the herd is often wrong in some ways, right? But that said, the broad, if you zoom out and you're looking at the broad long cycle, then yeah, the herd is correct, right? People are coming into Bitcoin. That's what we expect. Now, one other point I want to bring up with you before we get into some of the on-chain metric stuff, I find some of the power law stuff interesting in that it's talking about diminishing returns, diminishing volatility. And that's what we've seen. Like just statistically, objectively, we've seen this diminishing returns, diminishing volatility over time. Now, I know maybe you're not like a fan of it per se, but I'm curious your reaction on the, as this thing grows, we're going to see this diminishing returns. And do you agree with that? Do you think that's the way you should view it?
Yeah, it's a good question. So actually, I don't dislike the power law model. I dislike the way it's been sold and pitched by the originator, but that's a different it just that's a plan B problem in
Right,
my
because
view.
the concept is different from the person.
Concept is separate the art from the artist. So the art form, right? What we're looking at in terms of the model, it makes perfect sense because if what people I think don't quite intuitively recognize, it's a log of price and time, which means in order to go up an order of magnitude of time, you need an order of magnitude more. An order of magnitude in price, you need an order of magnitude more time. It's going to be slower. It's going to get increasingly slow if that model has any kind of validity. So I think it's interesting as a trajectory. I generally don't use models, and this is just my personal preference. The model can be fantastic, but the problem with it is that I don't believe it's baked in anything. It's really assuming a network effect, which could completely be true, but there's no way to verify until you live that world. So what I prefer to do when I look at a lot of the models I have, I care about what are investors doing. So it's more about looking at how investors are responding. Are people stacking and hodling, or are they starting to distribute, which is increasing the chance we hit some kind of ceiling? So the way I look at things, the power law could absolutely be the trajectory. I mean, I wouldn't hold Bitcoin if the power law pointing up into the sky in log scale wasn't true. That would make perfect sense. Do I use it in my analysis? Not really, because to me, for me as an analyst, what's the output? It's going up forever, Laura. Okay, I'm going to use that as my background. And now I'm going to look at everything that's going on in the in-between phase. And you mentioned before, like the difference between hodlers and traders. A lot of people actually get this wrong. I don't write for traders. And we actually did a survey recently. We asked, what do you classify yourself? Trader, hodler, how would you? 96% of people say they're hodlers. And I write for hodlers because at the end of the day, understanding why the market does what it does, it actually helps you navigate what's going on because we're all subject to the same emotions. And for a lot of people, Bitcoin is their life savings. It's my life savings. So in that regard, doesn't it make sense to have that like anchor for, all right, this is what the crowd's doing. If the market's going to go lower, I want to be prepared for it before it happens. I just never want to be surprised. I don't care that it's down. I just want to be ready and go, okay, I was kind of expecting it to be down. Now I can make decisions along the way.
Yeah. Okay, yeah, I mean, I mostly agree. I think one slight disagreement I would have is more just like maybe the characterization of the power law stuff, right? Like I don't, at least the way I look at it, I see it like it is a useful guide in terms of what is a decent benchmark, right? Because I'll give you an example. There were people even in 2021 cycle, there were people where if you said 200K, you were considered a bear. You were a loser, quote unquote, for not being bullish enough.
100K was
But if
guaranteed.
you looked at power law, it was kind of like, actually, yeah. Now, I wasn't looking as much at the power law at that time. Now, I'm sort of starting to see the logic of it and understand that even now, there are people who, are coming out saying 1 million this cycle. And it's like, no, it's just so far out of realistic possibility. It's just not realistic.
150K is an additional trillion, then a million is it's quite the sum.
Right, yeah, and it's just insane. And then there are people who are like, yeah, 500K this year and stuff. I mean, it's possible, but it's extremely, extremely unlikely. Unlikely that you just shouldn't. If you're trying to be rational and look at kind of, what are the probabilities here? It kind of gives you a guide in that sense. And I think one other thing that I've found interesting is the price seems to be sort of, it's almost like a magnet going back to kind of what the power law trend line is. Now, will that behavior continue? We don't know. Or maybe once we sort of really enter let's say the hype phase when retail really shows up, maybe we'll kind of run away from that trend line for a little bit. But for me, I've just found it useful just to sort of, as you said, manage our emotions in a way to sort of understand this is a realistic trajectory. This is not kind of overly hopium and not overly bearish. So that's one way I've found it useful. But at the same time, I think it's useful, and that's why I'm a subscriber of your Substack as well, because you can also look kind of more in a more detailed way, what's happening on chain. What are the short-term holders doing? What are the long-term holders doing? And look at some of these metrics. I think you were talking about SOPR recently. So SOPR, spent output profit ratio. Can you explain a little bit about that? Because you mentioned that it had a reset recently.
Yeah, absolutely. So, and I agree. I mean, what you were saying about power law, I think find the tools, find the analysts, find the people that help you. Everyone's got their own structure. Find the things that work for you to just ground yourself. Keep yourself in the real world. If you stay in the real world, you'll be surprised to the upside more often than you're surprised to the downside. If you keep that grounded view, it's just going to help everybody get through, what is a pretty chaotic asset at the best of times. Now, SOPR it's basically the Swiss Army knife. There's two metrics that if you do want to get into the world of on-chain data, you're actually going to need to learn three of them. Realized cap, which is basically the on-chain market cap. MVRV, which is the unrealized profit or loss multiple. So think about like an oscillator that tells you how in the money or out of the money the average guy is. And then SOPR, it's the sister of MVRV. It looks at realized. So where MVRV says, show me how much profit the guy who hasn't spent. What's his profit? SOPR is on this particular day, what was the average profit or loss locked in by people who did spend? So it's one of these useful tools where you can say, well, what's the incentive? Are people in a lot of profit with MVRV? And then when people take a lot of profit, I've now got confluence, right? It makes sense that we're going to start to top out when people are really up on their position and starting to take it. Now, you're right. SOPR has had a really healthy reset, actually. So what we look for in a lot of on-chain data, particularly with short-term holders, I actually want to see them buy high and then sell low. And particularly, I want them to sell low and take a loss. And this is not because I'm some kind of dude who wants to see people lose money. It's just the fact of the matter. This is what happens. And when it does happen, it's usually a nice flush out. And it will generally come alongside like a washing out of futures markets, some deleveraging. These things all tend to come in pairs. Funding rates are actually just futures SOPR. It's basically, they're exactly the same chart, which I think is beautiful in its own right. But it's telling you a story of when you've kind of washed out the weak hands. So SOPR's recently been trading below 1. And the reason we look at 1 is the break-even level. If people were taking profit, it would be higher. And if people are taking heavy losses, it will be lower. So as it goes lower, and I want it to be short and sharp, it's like these little V-shaped undercuts. If it goes underneath 1 and stays there and stays at a really deep level, it's basically saying that every single day, people are just going, get me out. I'm done. My sentiment is broken. I don't want to hold this thing. I was wrong. I'm out. If you get these short, sharp undercuts, it's more of like a washout. The people who were going to sell, they panic, they exit, and then that's it. The dust is over. So you want these short, sharp resets. And so far, that appears to be what's going on. So a lot of these metrics, whether it's funding rates, SOPR, MVRVs, they've all reset to a nice, healthy level. Like if you had asked me 2 years ago, I need you to sit down and tell me a checklist for what the bottom of a correction looks like. The current conditions that we have, and by the way, bottoms take time to hammer out, but the conditions we currently have are exactly what I would have written down. So yes, there is no doubt there's a potential that this correction could deteriorate and become some kind of longer, bear market. And that's a whole different topic. That could happen. Yes. I don't personally deem it to be highly probable. And just given the set of evidence in front of me, it kind of looks like every other correction in every other bull market. If I was to give it a grading, it's like 95% the same, species as a normal correction. And there's like a 5% mutation that might look a little bit like a bear. So it's like, which one do I take? I can't go with the 5% because, the father's probably a correction.
Yeah, I think that it makes so much sense, even from just like a gut feel. Like
Totally.
if you're looking at the sentiment online, people were crazy bullish at 109K. They were kind of like, oh, we're going to the moon tomorrow, this strategic reserve, this, that, whatever other, hype thing. And there's kind of all these kind of hopium narratives that people sometimes talk about. And then when we were at like 80K or just under 80K, people were like, oh, it's all over. The cycle is over, guys. Just pack it up. Yeah. See you in 4 years. This is the kind of rhetoric or the talk we were seeing online. Whereas like, let's say the real long-term holders who kind of knew what was up, I think most of them were kind of like, what do you mean? This is just a normal bull market correction, right? Like we've lived through many of these. Just wait it out or keep stacking if you've got fiat. These are the kind of ways to see that. So I guess for you then, you would see it like 80K-ish was like a value zone, right? And just for listeners, today, it's the 25th of March. Price now is about $86,000 in USD terms. So yeah, I guess, are you seeing it like, we've kind of, we went through a correction and now we're sort of coming on the way back up?
Yeah, so it's a good question. So I think we've come off a high of like 88, and the piece that I just released was just trying to get a bit of a gut feel, and something I've definitely found. I say this a lot. If I don't have a good read, and by the way, the current market conditions with like intraday tariffs and just like stuff changes every 5 minutes, it's chaos. The best analysts in the world can't work out what's going on. So if you're feeling a bit confused, you're not alone. When I look at the current state of affairs and like you're like, I just don't know, I always say, do I see myself in the data? And I find on-chain data is so powerful for this because more often than not, if you've been around for a cycle or two, you've got your Bitcoiner intuition. On-chain data actually helps me, like for me personally, it helps me go, my intuition's correct. This is how I feel. This is my gut feel. Like if I didn't have any data in front of me, I'd be looking at this correction and going, it's been far worse. Right? I've dealt with worse. I don't feel like my bullish sentiment is shattered. I'm like, oh, it's just part of the process. So when I look at the on-chain data, by and large, that seems to be how people who've been around for a while, we're seeing them take less profit. Old hands have stopped selling. Generally speaking, it looks like we're getting some top buyers capitulating. If hodlers aren't selling, I would hazard a guess that 7 out of 10 of them have probably moved back into accumulation mode. That's usually how these things go. So from my perspective, you're right. 110 was complete chaos, right? Everyone was singing, there is no ceiling. It's going to go up forever. That's usually, Trump's just launched his token. It's a circus. Once we got back down to 100, that zone between about 90 and 100K, it's a crazy stat. 52% of all the dollars, if we value all the UTXOs based on when they moved on chain, 52% of all the wealth stored in Bitcoin had a price above 90K. A simply incredible statistic. That represents about 25% of the Bitcoin. But remember, if you got one Bitcoin at 100K, it's worth 10 times more than a Bitcoin that last moved at 10K. So that's how you get those kind of disparities. Now, when we started to sell off, I was talking about this air pocket. It was between 73 and 86. And the reality is we just didn't have that many coins transact there. And for whatever reason, like a CME gap, the market just seems to want to go there and find out how much demand is there. So because we didn't get many transactions in that point, the market it seeks out pain. It just looked to me like a really obvious target. Every trader in the world would have seen it on the volume profile. They could have seen it in on-chain data. It was just an obvious place to go. We're in the process of backfilling that as we speak. But my general mind map for where we are at the moment, the 2024 chop range, the amount of coins that transacted there is incredible. I would be amazed if we spent much time in or below that zone. To me, I feel like we belong above $1 trillion. That's 50K. I think we deserve a premium to $1 trillion. I think we get down to 1.4. Anyone who's done any work on Bitcoin is going to be just emptying their wallets, finding ways to just buy as much as they can. So to me, between like here and 75 is basically a value zone. Anything below that, I'm selling chairs, man. I'm like finding anything I can get rid of because it just makes no sense to go below that level in my view.
Yeah, interesting. And so, yeah, I guess one way to sort of think of it is there's like as Bitcoin grows over time, there's almost like a fair value, quote unquote.
Absolutely.
And when we're kind of over that, people are selling, and when we're under that, people are buying, as in the smart money. Let's say it this way. The smart money is selling when we're way over that fair value, and the smart money is buying when we're well under, as you said, like when we're down at like 75K. That's like a extremely good value
Thank you
zone.
very much. I'll take it.
Yeah, people are like, yeah, if they've got some investment property, maybe they're thinking, okay, how can I sell this and put that fiat into Bitcoin because this is a great value time, right? So I think that's kind of the mindset, or at least that's one way to think about it. It's interesting you mentioned the kind of, air pockets and CME gap. To me, this reminds me of that meme. It's like the, I don't know this air gap thing, and at this point I'm too afraid to ask, or the CME Futures, right? Because people have been talking about CME Futures. I've never really understood it. So what is this CME Futures? I've been too afraid to ask. What's your perspective on that?
Yeah, it's a funny thing. So it's a bit of a hangover. So I read a book way back in the day. It was called Insider Buy Super Stocks. It was kind of like the first trading book that I ever read. And it was quite good, but it probably doesn't have the same relevance anymore. But it was just about trying to spot chart patterns and just rules that just happen. You can find 1,001 explanations for it, but they're just things that markets do. And one of them was gaps. The probability that, because basically what happens with a gap, because traditional markets obviously trade 9 to 5 and they close over weekends, if something happens on a Sunday and the oil market has some kind of blow up or something happens, oil stocks might open gapped higher or gapped lower. So it's basically like they closed at $20 a share, but something really good happened and suddenly they should be worth $25 a share. That gap, traders now have, I think the right saying for this, in a sea of sand, a single flag becomes a target. If you're out there in the desert and all you can see is one flag in the distance, where do you reckon everyone's going to walk? It's like a shelling point. I'm going to walk towards that flag because where the hell else am I going to go? I may as well go there. So I think the gap forms this thing that everyone can see and they're like, that feels like we should go there because I don't know where else to go. So that's one of the dynamics. There's also an element of testing demand. So I view markets as a bit of a confidence machine. If you think about what price is, we spent 7-8 months chopping sideways between 50 and 70. The market proved that we belong there, right? Because we actually tried that twice in 2021. We got to 1.2 trillion in April and we got 50%. And then we got there again in November and we had the 2022 bear market. Now we got up there in whatever it was, March, and then we stayed above 1.2 trillion. Every time it went below 50, 60K, the market came in and bid it, pushed it higher again. The market said we belong up here. And then we sprung up to 2 trillion. We've pulled back from 2 trillion, but we haven't gone back to 1 trillion. So the market's proven the confidence that we belong above that zone. But it doesn't know about that gap. No one traded coins between 73 and 86. Well, now we're starting to backfill and the bulls are now proving how much do you, if you loved it at 100K, how much do you love it at 85 and 86 and 78? And if you prove that you actually want to buy this thing here, now we'll go back and test 100 and see if all those guys who are still hodling from up there, and if they don't do anything, now we're going 120. And then we're going to find out who wants to sell up there. This is just how markets work. So you kind of think about it as a confidence machine. We've proven we belong there, tried the next level, not enough, come back down a little bit. All right, now we're good to go.
Yeah, that makes a lot of sense. Now, one other thing that's probably interesting, just to get your perspective as you're looking at on-chain, but also what's happening in the macro world, are ETF buyers who are not necessarily going to show up on-chain. Now, I guess it's fair to say, let's say BlackRock, their ETF buys Bitcoin, and then it goes to their broker and their custodian, and actually in the background, maybe it's held at Coinbase custody, but I guess it's just it's going to show up in a different way on-chain, isn't it?
Totally. And this is one of the other things, right? The data will also shift and evolve and change. So at a very mechanical level, what are the ETFs? They're exactly the same as Binance. Coins go in, there's like a net flow in and out as people buy and withdraw, or there's a net flow in and out of the ETFs. And then other people just trade around coins on the inside. They trade the shares, and unless there's a net change, there's no delta. But I mentioned before, that a lot of the metrics we look at only counts if the coins are spent. So yes, the ETFs will show up in things like the hodl waves. There'll probably be a big chunk of IBIT, for example, that doesn't move, and they'll have a handful of UTXOs like their hot wallet equivalent. But that's just going to look exactly the same as Binance does in the hodl waves. But if you look at spending mechanics, the vast, vast majority, like 80% plus of all coins spent every day are either deposited or withdrawn from a spot exchange. So even if you've got 0.1% or 1%, that's the ETFs doing a transaction, one transaction per day, the exchanges just dominate. So we can still pull that information from there. But what we can also do is we can say, well, look, we've also got ETF trade volume, we've got inflows and outflows, we've got ETF prices, we've got all these metrics now associated with the ETFs. And whilst, yes, my specialization is on-chain, I look at futures, I look at options, I look at ETFs, spot, on-chain, and more often than not, all these different market sectors give us a very similar picture across the board. So it's a really, really useful tool set, and we're very lucky in the world of Bitcoin that the data is so freely available. For anyone who's doing any kind of analysis, it doesn't take long if you're in the TradFi world that you start hitting roadblocks where it's just really hard to get data. You can get it, but you got to put you got to get a Bloomberg terminal, or it's all behind very heavy paywalls. Bitcoin, we've got all the data almost for free. Pretty much everything you can get for Bitcoin is free, which is an incredible advantage. Honestly, when I look at stocks and gold and other things I'm trying to analyze, I feel blind because I don't have the tools I have for Bitcoin, which to me is just incredible.
Right, there's no SOPR for gold. There's no MVRV for stocks, right?
My bet is that one day, the NASDAQ and the New York Stock Exchange will work this out, and they will eventually, because they're the ones that can see all these cost bases. They can see this stuff. They can see the UTXOs, so to speak, of all these stocks. One day they're going to work this out, and they're going to build SOPR and MVRV, and that's going to be a whole a revenue generation opportunity that they haven't even thought about yet.
Yeah, it totally makes sense. Now I want you to, I know this is something probably you and I agree on. There's been some kind of false hopium narratives that kind of go around, things like, I'd like to get your response on some of these. So let's start with Mr. 100.
Oh no. Yes. So Mr. 100, I'm going to give massive credit to Sani, who's done an enormous amount of work just labeling UTXOs. He's a one-man band, and he's got some of the best labels in the industry. Mr. 100 is an exchange, folks. So and this is what I say with whale. I say don't whale watch kids, and it's very simply why. If you do not know at a UTXO level whether you're tracking an exchange or a whale, then your data could be perfectly wrong, which means your analysis could be perfectly wrong. And if you don't know if it's perfectly wrong, then it's useless. So if Mr. 100 is buying 100 coins a day, that could actually be 100 coins of deposits, which means that that's actually selling. So you could have it perfectly backwards, but unless you know the answer to that, and most people don't, you shouldn't be using whale data. The noise to signal ratio is through the roof. Don't use whale data unless you're really in the weeds, and basically no one is. I'm not. I choose not to use it because I don't think there's any signal.
Yeah, excellently explained. And just shout out there, as you mentioned, at Sunny EXP. So he's the guy who did time chain index, and he was kind of categorizing on chain. Oh, this looks like this output and that Binance or whatever
I don't
large
know where
exchanges.
He gets the time to do it, and I think he'd have the same opinion.
Yeah, I think he might have recently stepped a little bit back from that, but anyway, nevertheless, next one, supply shock.
Yes, so supply shock. The reality is supply shocks happen, but I think the way people think about it is that they think about it as like this monumental event. But the reality is, if in order for us to go from 73K to 100K, in my opinion, you needed 8 months of reaccumulation. If we didn't have that 8 months of reaccumulation, you can't springboard up to $2 trillion in a short moment. So the other way to think about it, the supply shock, that was the process of going from 73 to 100, was actually that whole thing, right? That whole year-long experience, that's the process. So yes, supply shocks can happen, but looking at things on like just the green candle, you're missing the precursor. Without the chop, you don't get the green candle. So, and the other thing is that when you rally, if there was a genuine supply shock, there wouldn't be, it would just keep going. But what happens is price goes up and people go, oh, that's my price. I'm going to take some chips off the table. Coins come back to market, right? Every single price, by definition, has a buyer and a seller. Price goes up, you're going to generate more sellers by definition. So the concept of a supply shock, it's a cute narrative. I personally think it clouds people's judgment because it's just not precise enough in my view.
The lead sponsor of this show is Bold, the best place to buy, sell, and save Bitcoin. For listeners in the US, Bold lets you secure your financial future with complete peace of mind by integrating a low-fee, Bitcoin-only brokerage with next-gen multi-sig vaults. With Bold, you can smash buy Bitcoin or set a DCA plan for only 0.99% fees and seamlessly deposit the Bitcoin direct to your Bold vault. The Bold Vault is a 2 of 3 collaborative multi-sig where you hold 2 keys and Bold holds 1 as a redundant backup, protecting against loss or theft. You can use Trezor, Ledger, or Cold Card hardware wallets to spin up a Bold Vault in just a few minutes, and the Bold Vault is the only collaborative custody vault available with 0 monthly fees. They're also offering 0 fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Try Bold today and upgrade your stacking experience over at getbold.io. And now, back to the show. Right, and related and kind of a similar concept, people talk about, coins on exchanges, right? And so I guess this is the marriage of the two, right? Because it's whale watching and this supply shock concept. Because people would, and this is like a big thing in the 21-22 cycle, I think we've all learned, we've moved on and understood that this is not a good way to think about it, but basically people would show these charts of, this is what we believe the coins on exchanges are, and once that chart, once it hits really low, then all of a sudden we're going to the moon because right?
There's
And
only
it's the same-
2.3 million. I mean, how many times have you heard there's only 2.3 million coins? For whatever reason, it's always 2.3 million. It's been 2.3 million since I've been in this industry for like 7 years. And then you're just like, well, hang on a second. If it's always declining, why is it always 2.3 million? And look, there's a whole lot of reasons for this. First things first, managing the labels of exchanges is a full-time job for a full team of professional data scientists. It is not an easy job. This is why data providers have these teams. And each provider has their own heuristics, their own labels. They're never going to be the same, right? Glassnode's not going to be the same as CryptoQuant, not going to be the same as CoinGlass. They've all got, some are better maintained than others, right? I've worked at Glassnode, so I know that their exchange labels are very well maintained. I can't speak for anyone else because I haven't worked there. But maintaining these labels is a serious job. And quite often what happens, how do we stay at 2.3 million? It's usually because they're always finding new exchanges to implement. If you find a new Binance hot wallet, yes, you may have found it yesterday, but it's been around for 2.5 years. So then you've got to backdate all of your history. So all the rest of the history has to adjust. And it's just really, really hard. The way I look at it, unless you're a professional and you are using algorithmic trading and looking at coins actually moving in and out of exchanges as part of your risk model or your trading model, unless you're doing that, looking at a balance of exchange chart probably isn't going to give you the edge you think it is. It's just not that simple.
Yeah. Another common kind of bull hopium number is the multiplier. The multiplier effect. What's the multiplier effect?
So the multiplier effect lives in the same family as supply squeeze. And I actually wrote a piece on this my background civil engineering. So I solve a lot of stuff on the back of an envelope, right? Give me a quick spreadsheet and I'll find out a rough ballpark. And the number that everyone threw around was 100x multiplier. And just to summarize what that means, if you put $1 into the market, you buy $1 worth of Bitcoin, the implication is that you're actually going to create $100 change on the market cap. If you sell $1 worth of Bitcoin, it's going to go down by $100. So there's this because not all the coins are available, there's like a multiplied effect because of liquidity. That does exist in everything, not just Bitcoin, in all assets, because not every asset trades at every price. However, 100x is insane. So I was like, okay, let's just break this myth as far as I can. First thing I did is, this was back in, I don't know, would have been March, April or something like that. Probably May, actually, last year. And I looked at the ETFs. And by that point in time, the ETFs probably had like 10 billion in inflows. And I looked at for 10 billion of inflows, let's imagine the ETFs are the only buyer, which I think everyone would agree is bullshit. Because what about the 15 years of other markets that existed pre-ETFs? They didn't just evaporate. So a very conservative assumption, the ETFs are the only buyer, $10 billion, whatever it is, and it's created X amount of price change. And when you do just that simple sum, I got a multiplier of 30x. So we know that that's wrong. So Please, somebody explain to me how you got 100x. I can't get to 30 and justify it. So anyway, when I fully run the numbers, I came up with a number. It's typically about 3 to 5x. So to kind of pare everything back, suddenly 3 to 5x, that's kind of, I think most people listening be like, yeah, that's probably about right. There's been one moment, one day where it hit 8x. That's the highest it's ever been by my calcs. It's, it's part of the supply shock thing, but it exists, but it's not at the 100x multiplier. So that's just nonsense.
Right. Yeah. Any other pet peeves or false narratives that you want to dispel?
No, well, one that I find very interesting is, and it particularly comes from, I was talking to Knut the other day about this. It comes from whether we want to call Bitcoin maximalists or the monetary maximalists. There's a crew of folks who've been around Bitcoin for a long time, and they seem to think that on-chain data is voodoo, to which, okay, that's fine. But what I would just challenge is go, guys, the UTXO set is Bitcoin. It is the ledger. That data is what makes Bitcoin so beautiful. It's a ledger full of Bitcoiners making decisions at the end of the day. Now, some of those Bitcoiners were fast money people who just came and speculated and lost everything. Some of them have been around for many, many years, and they sometimes take chips off the table to improve their life, right? That's what a lot of hodlers do. You've been around for long enough, go and improve your life. That's what it's for. It's your savings. So at the end of the day, I find it very interesting that there's folks who believe in Bitcoin to the extent that you and I do, and yet will look at on-chain data and be like, there's nothing here. It's like, but of course there's something here. What I think a lot of people mix up is they go, well, there's been some not so great analysis in previous cycles. It proved wrong, therefore hold discipline wrong. Well, not quite, right? That's like saying that, the under 12s aren't very good at football, so therefore football is a shit sport. It's kind of the same magnitude. There's going to be people who do better work. There's going to be people who spend the time and do the proof of work to get good at any skill. Doesn't matter what it is. Just because one dude can't cut wood doesn't mean that carpentry is a shit skill. So that's the way I would think about it. But in this case, we have every Bitcoiner's transaction in one golden record sitting on that hard drive in your node. All we're doing is looking for patterns in how Bitcoiners behave. And funnily enough, we all seem to behave the same way, cycle after cycle. Can we pull information out of that? Yes, we can.
Yeah, and I think the way I agree with you, I'm not disagreeing. I would say in the earlier years of chain analysis, in this sense, I would say there was a lot of just kind of fluff and talk, and maybe in, let's say, the 21 cycle, there would be people who just kind of, because again, we live in this kind of attention economy, people want engagement, and there were people who would just sort of do the very lazy, posting this, therefore bullish, therefore give me some likes and retweets and follow me because I'm going to tell you what you want to hear. So I think there was that, and I think that is what drove that kind of reaction of, hey, this is kind of snake oil kind of stuff. Whereas now, I think, at least the way I'm seeing it, is there can be legitimate, let's say, practitioners of, looking at what's happening on chain, so long as they are actually, bullish when it's right to be bullish and bearish when it's right to be bearish, then it actually can make sense. And it actually,
absolutely,
it's like a poker player who probabilistically, goes in with pocket aces, and he'll still lose sometimes, but probably, playing the odds, playing the expected value, he was making the right decision. It's a similar thing here, that maybe using some of these tools, you can tip the odds in your favor. It's not a perfect science. It's not a perfect kind of predictive thing, but it tips the odds in your favor. I think that's how I'm seeing it.
And the way that I look at it. Yeah, no, exactly. And again, I think some people can trade with it. And certainly I talk to a lot of my clients who are traders, but the vast majority of us are hodlers. And I write for hodlers. Like, the whole point of the thing is for people who've been around. We all come into this market. You buy a bunch of Bitcoin. Most of us have tried our hand at trading. You probably found it's it's a difficult thing to do, right? It's not overly fun. You probably lose a bunch of money. It takes a lot of time and energy. It's a full-time job. So you realize I'm actually not a trader. I'm a hodler. But you still want to understand why the market does what it does. And when you understand why in anything, it just makes it so much easier. So yeah, I use the analogy of the poker table quite a bit. I view it as you're sitting at the table. I can't see what cards are about to come out in terms of Texas Hold'em. I can't tell the future. But what I can do is I can see one of everyone else's card, right? It's better than just looking at my hand, because then I'm just stuck in my own world being like, is that a good thing? Is that a bad thing? But here I can say, oh, he feels confident. He's doing okay. Like, he's got a decent hand, but you can't see everything. But the world is full of incomplete information. If you've just got more information, you can make a decision. All right, all the guys who I want to be, who've held their coins for 5 years, right now they're selling a stack of coin. And the way I would look at that, and I use two personas for Check the Analyst. If you're a retiree, right, and you need the next 3 years of runway and Bitcoin is a huge part of your portfolio, if the smart guys are cashing a bunch out, it might be the right time for you to just buy that 3 years of runway. Give yourself the thing that's more important to you, which is your life. If you're a hodler like me, I'm probably just not going to stack as many sats when that happens. I'm just going to take a step back, and I'm going to wait for all the guys who do buy high to sell at a lower price, because they always do. And that's where I'm going to step in. And now I can be more aggressive and get 5, 10, 15, 20% more sats every single time I DCA. Compound that over my life. It's not trading. It's just being more strategic, using your Bitcoiner intuition to make better decisions about Bitcoin.
Mm-hmm. Yeah. And I think zooming out, as you said, it's not that we are bearish or whatever. It's more about, I think, dispelling, let's say, false narratives in a way, so that people can be more realistic and feel more solid in their long-term bullishness, right? Because you and I obviously are super bullish. Like, I think both of us believe, at least most kind of hardcore Bitcoiners, we believe it's going to be the money of the world someday. Maybe not tomorrow. It might be, a few decades from now. But this is kind of how to analyze it. So any as we've spoken about, kind of our theme has been there is no cycle. So do you want to just kind of summarize and wrap things up?
Yeah, so I think at the end of the day, markets are just information. And the only thing you can control is your decisions. That's it. That's the only thing you have control over. The market's like the tide. It's just going to go in and out, and you can't stop the moons. You can't stop the water. You can't swim against it because you'll drown. The only thing you can do is make better decisions on your front. And look, I think at the end of the day, every Bitcoiner develops your own intuition. Trust it, right? For the most part, if you've seen these markets play out before, your instinct is going to be better than most people's analysis. What I think on-chain data is really useful for is just having that extra anchor to be like, this is what my gut feel tells me. Hey, look, I can see it happening over here. I can see myself on the data. Now I can be even more confident that my gut feeling is right. Or if you see something where you're feeling like, hey, it's really overheated here, but then you go and look at the metrics, you're like, no one's selling. It's like, hey, maybe it's actually unfounded. Maybe I should go and like review why my emotions are in a certain position. So that's the way I think about it. I think it is Bitcoin. Bitcoin's telling you about Bitcoiners. Use that information to guide your gut feeling. And the best thing about all this stuff is that all this charts and data are free. You can access the whole world of on-chain data and all this. Everything is free. It's just about upskilling and go and use the tools that help you survive in these markets. And honestly, you don't need that much. Keep it simple and, enjoy it. Enjoy the ride.
Fantastic. Well, listeners, go and check it out. As I mentioned, I'm a subscriber myself. I think it's a great product, not a paid endorsement. So yeah, check out Checkmate. So for people following on X, it's _Checkmate_, and then the website is checkonchain.com. So Check, thanks for joining me.
Good on you, mate. Thanks a lot. It's been a pleasure.